Welcome to Market Monday from the investment team in the trust department at the First National Bank. Over the next couple of weeks, we've got a few key data points that will give some clarity as to whether we're going to see a recession or whether we're going to see that soft landing that everyone's been talking about, where the Fed is able to engineer a rate hiking cycle to its conclusion without causing a recession. As we've said before, that's a very rare historical occurrence. Not to say it's impossible. The odds just don't favor that outcome. And the first thing is tomorrow, where we get retail sales information, and that's expected to show a 0.4% growth. Retail sales being the main driver of economic growth, our GDP, our gross domestic product growth, this is a key sign. And if the number comes in meaningfully weaker than expected, that could augur that we're going to see a recession later this year, or potentially early in 2024, which is what it's looking more likely as now, due to strength in the economy. As we go through, we'll get information about manufacturing. That's expected to show a decline. Information about real estate, production, and capacity utilization. These numbers are pretty key. Notice that capacity utilization is expected to trend up from its last reading, and industrial production is expected to come in positive when it had a negative last reading, indicating renewed strength in the economy. We'll get labor market information and the leading economic indicators, which, that's expected to show a decline. And historically, that leading indicator index, when it's negative, has been pretty accurate as a predictor of recessions going forward after those readings, and it's consistent. So the prior reading was a negative 0.7%. The reading that's expected now is 0.4% to the negative, and if it comes in worse than that, that augurs that we're seeing some recessionary type pressures coming into the economy. And we'll get purchasing managers index, we'll get labor market durable goods orders. That's important as well. That's expected to show a pretty steep decline relative to the last reading. That's a negative 3.8% is what's expected versus a prior reading of 4.6% of growth. So that's a big swing. We'll get more information about sentiment and confidence. This is key. We'll get a GDP second reading, which the initial reading for the second quarter was 2.4% versus what was expected of a 2% rise. So the economy was shown to have grown more strongly than expected. No one's out yet with their forecast for us to share with you, but we're imagining that strength is likely to continue. Perhaps this number even comes up a little higher than this 2.4%. Certainly if it comes in below that, that would indicate that there's less optimism in the markets, or at least in the economy. And we'll get the GDP price index, the core PCE price index, which is what the Federal Reserve looks at to make its decision. That last reading was 3.8%. There hasn't been a forecast made yet, but we're going to go ahead and say we're not expecting it to be meaningfully below that in terms of what that would be forecast to be. Rounding it out with labor market information and more sentiment information. That rounds out the economy over the next couple of weeks. Want to talk about volatility. There was an article that was pretty important that came last week to Bloomberg, which said that dealers are positioning in the options market for potentially increased volatility. And what that means is over the past year that the market has come out of the bear market that it was in 2022, it's not been volatile. And in fact, over the past few years, it's not been very volatile. The volatility has been trending down from the 2020 highs, which were among the all-time highest that this VIX volatility index has ever read. That was in March of 2020 when the panic of COVID was at its height. So what does that mean when the dealers are positioning their book for increased volatility? Well, all along through the past year, they've been positioned to take advantage of what little volatility there was, while not taking on a lot of risk. And that makes sense because the dealers in the securities market, particularly in stocks, their job is to inventory positions and hold them to facilitate customer trades. And when the customer trades are not expected to cause damage to the dealer that's taking the other side of them, they're potentially not needing to hedge off in the options market or with futures. Now, positioning indicates that they're starting to take hedges to protect the downside. And when they're doing that, they're expecting this volatility, which has been trending down basically since 2020 and getting lower and lower and lower. This is a pretty low level historically. Generally, you want to see it, below 20, this VIX, when the market is calm. But notice how it spikes aggressively and frequently. And when it spikes, it's generally in response to some event, and there's a catalyst. And looking forward to the future, what do we have going on? Well, historically, the months of September and October have generated the most market volatility out of any other month. And if you look at most quote-unquote crashes that have occurred in the market, they've occurred in September or October or March. And that's not to say that we're expecting anything of the sort, but let's look at what the market's been doing. This is the S&P 500, and we've just projected out from the past 5 years, looking at the low, which was back in August of 2020. This was March of 2020, and where we are now, which is 104% increase. In other words, it's just over doubled from its level at the lows of the March 2020 panic. And we've seen a strong rally out of a real bear market, the first real bear market that we've seen in quite a while that was of that magnitude. It lasted all of 2022. So potentially there's some profit taking that could happen here. We have another earnings season coming into the end of the year that may or may not, move the needle in terms of stock prices. We have the potential for economic data to take a turn to indicate recession. We have a Federal Reserve that might take a turn to continue its aggressive hiking cycle instead of pausing like everyone expects. So there is potential for some volatility as we go into the end of the year. However, we're not expecting a serious down move again. Frankly, we would expect any kind of pullbacks to be bought by longer term investors who are out on a bigger time frame. So the market still looks very strong, but it has rolled over a little bit in the most recent weeks, which coincides with earnings season, by the way. And there's a potential for a pause here and a choppy trading range. It's worth noting that volatility as expressed by the daily range of the S&P 500 has gone up by approximately 50% over the past week to 2 weeks from what it was prior, which indicates that more uncertainty is coming into the market. Doesn't mean that we're going to see a drop, but it does mean that the waters might get a little choppy as we move forward. And looking into rates, we're going to start with the corporate bond yields, which are going up over the longer time frames. Now, what that means is, think of it this way. The 10-year note generally is regarded as a proxy for long-term inflation expectations by institutional investors. It is essentially a break-even rate because the government bond in the U.S. Treasury is considered to be a risk-free asset. So if it's risk-free, the only factor that you really are concerned with, you're not concerned with the defaults by the U.S. government. You're only concerned with what's the impact of inflation on my purchasing power that I'm putting to work in this bond. And institutions and individuals will buy that paper up into the yield that they expect inflation to be at, where they expect to break even in the long run over that 10-year or longer period. It's telling that these rates are going up over the longer time frame. On the other hand, they're subtly going up, although at a less aggressive rate, on the short end of the curve, which indicates expectations that the Federal Reserve is likely to pause. So what this yield curve is telling us is they're expecting the Fed to pause, and they're expecting a long-term inflation rate of about just a little over 4%, 4.16% on 10-year paper. That's markedly different than what the Federal Reserve has been talking about as 2% being its target, but it is expected to drift there over the next couple of years back into a range where we can expect lower than 4% inflation. Although for now, that is what the expectation is, and we've seen nothing to change that over the shorter term. Looking into corporate bonds, the situation's very good for income investors. We're basically north of 5% all the way across the yield curve in corporate high quality bonds, and that's great for income investors. We don't think that we're out of the woods yet with inflation, and we don't think rates have halted their climb. And so, even though these rates have gone up pretty substantially in the corporate curve as well, we're still not looking at this slowing down in a meaningful degree. We expect rates to continue to trickle up, and we are expecting rates to continue to trickle up in the treasuries unless we see signs that inflation is coming under control. So back to the S&P 500, what are we expecting over the short term? Over the short term, a little bit of chop, perhaps some bigger ranges, a little bit of indecisiveness on market participants. But again, and we do this every time, so we're going to do this now, we're going to zoom out and take a long view, because this is the type of move we're more interested in, what's happening over the longer time frame. Are we worried when these events are going on? Here was the 2018 bear market. Here was COVID. Here was the bear market of 2022. Here was, sovereign debt crises over in Europe. We had the 2008 financial crisis, and it was still a good time to be a buyer of stocks, even through any of those scary times. In fact, it was almost better to be a buyer of the stocks when times were volatile and scary than it was to be buying them at time when prices were orderly. So instead of trying to time the market, we have developed a long-term investment strategy designed to achieve clients' goals, and we need to adhere to that. We don't need to be making changes to long-term plans based on short-term events in the market. If you have questions, if you're worried about markets, if you have questions, and if you're worried about the economy, call us. We're here to talk. Hope you've enjoyed this video. Have a great day.